From the morning reading, buyers and sellers balanced at support. Tesla falls after earnings. 4 of 9 sectors moved higher on Wednesday. XLE, XLV, and XLK were the strongest sectors, while XLY was the weakest sector. Oil futures rose 46 cents to close at 44.51. Breadth strengthened as decliners led 1598 to 1434 on the New York Stock Exchange and 1643 to 936 on the Nasdaq. SPY, diamonds, and Qs closed near short-term support. The IWM closed below last week's low. Spiders, diamonds, and IWM are still bull flag patterns. It's important to be defensive this week as the market flattens out. Stocks have moved a lot without much to show for it. The S&P 500 ended April only 20 points higher than where it closed in April of 2015. Despite essentially no change, it moved nearly 18% from high to low during the year. As pointed out by a prominent hedge fund manager, when stocks see extreme volatility, it has often led to a change in trend, and we see some evidence of that here. Tech stocks just can't win. The Nasdaq Composite has declined 10 out of the past 11 days, its most concentrated losing streak since March 2009. Other times it suffered such pressure, its short-term returns tended to be weak, especially when it was within 10% of a 52-week high at the time. According to Lipper, investors have pulled more than $20 billion from mutual funds and ETFs over the past 4 weeks. That ranks in the bottom 4% of all 4-week totals since at least 2002. Typically, this kind of outflow has occurred after a decline and before a rally, but not exclusively. It also happened in December, right before stocks tanked, but there could have been some seasonal influences with that. There isn't a good explanation for the latest outflow other than skepticism among investors, which is in contrast to many other indicators we follow. There is no good way to reconcile this other than to have a lower confidence level about the reward and risk ratio as it looks to go forward. The Russian defensive stocks has been a boon to utilities. Almost every member of the Dow Jones Utility Average is above its short, medium, and long-term averages, which has tended to precede some weakness in those stocks. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:02 a.m. Central Time, and I'm recording this in preparation for the market day of May the 6th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce into our morning report. And a bit of weakness in the overnight across all 4 of the U.S. broad market indices. At the time of this cut, the S&P was down over 6 points, or about 1/3%. Russell was down just below scratch. Nasdaq down about 1/4%, as was the Dow futures. China down big, down 2.83%. Hong Kong down about 1.6%. Japan looks to be back open, and they were down about 1/4%. Germany down about 3/4%, and the United Kingdom down nearly 1%. And macroeconomic reports for today in the United States. The primary stuff, of course, is all associated with the monthly employment report. And many people will be watching very carefully to see what that says about the health of the U.S. economy. And that could be a significant mover in its impact on and influence on what happens with this morning's trading. Let's go ahead and go over to volatility. We have been slightly increasing. If you look at the 5-day average true range versus the 10-day, you have short-term VIX pretty much in lock. It's been in the last several days right around 15, still at 15.37. Skew is benign. IV percentile on all 4 products are very, very low. On the S&P of 14, the Russell a 16, the Nasdaq a 21, and the Dow a 15. No standard deviation moves were put in on any of the 4 broad market indices yesterday on a close-to-close basis. And you see actually that's true for the last couple days after following a cluster of rather unstable action going both directions. In terms of the current charts, let's go ahead and go to that, and you see how we continue to get breakdown. And while these have gotten to be smaller candles of late, and this is certainly not the violent weakness, and you have to note the character here, while we've had a very weak trend ever since we came up and touched the bottom of this area of resistance. We've had some 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 trading sessions now where our action has just been slowly ebbing down from the high up here. We call it 2105 right now. We're currently about 2038. So, you know, some 70 points that we've dropped, so not an insignificant amount, and yet it's done that in 12 sessions, really just for the most part a few points at a time. So you have to give that the bulls still have some power here. This is not falling apart coming off of this area, yet at the same time we continue to get lower daily lows, and you notice that the close, and of course the market's still open on this day. This candle's still live, but you know, clearly we continue to probe lower and lower and lower, and the bulls are giving up each day some ground. So this is pretty interesting going forward. The question is where does it find support? We think the most likely place to find support is around 2025 in this area. And remember, this was kind of a sloppy bottom here, so don't get too hung up on any one number. Really anywhere from 2030 and change down to that 2025 area, and you could even overshoot that slightly and then still be, you know, general support from all this activity back here. So we don't seem to have a long ways to go before we would find some modicum of support, and yet at the same time, of course, pot odds to the upside, you start to run into a lot of overhead resistance, but then you kind of move to the upside. So there's not a lot of play left here without some energy coming into the market to kind of bust it through either the bottom or to the top. Now, things like monthly employment reports can be that type of stimulus to take the market with energy through those kinds of areas of support or resistance. You see that's our expected support. If we were to start moving up, you'd start running into moving average resistances and so forth, but also we have a diagonal resistance up here in this area, so not likely to get up above about 2075 without running into more stiff. So this is likely, and we think the most current forecast is that we have sideways choppiness kind of action absent some sort of new significant information. The Dow, we'll take a quick look at that, though it's been looking very, very much the same as the S&P. The NASDAQ has been showing also deterioration and continued weakness. And then finally, the Russell also clearly has broken down through the channel that it had and is coming down. In terms of bonds, bonds would seem to be indicating that, you know, the equity should be going down. So this has been correlated as you would expect, and we've had a clear breakout here. It'll be interesting to see what happens. Again, kind of like with equities coming into an area of support, bonds are going to come into an area of resistance in the not too distant price action. So there's a lot of reasons why the market could continue to be somewhat sideways in this action. We see volatility has been pretty much locked in a sideways pattern, not really doing anything, running into its own areas of resistance, and yet also, you know, clearly not at the lower part of that channel there either. And then we'll take finally a look at gold. We've been continuing to watch gold. Gold could, you know, set up with another bull flag pattern if you go just above the top of this candle here, that would trigger in a bull flag entry. Okay, and I think that's enough for the charts for today. In terms of the daily report, we continue to witness the deterioration across all the different measures. And we've not really had much to say about in terms of improvement. There has not been really any of these indicators that have started to show that this weakness is coming to an end. We're still phase 5 on the market trend intermediate term phase opinion, the end short term, the break of diagonal and horizontal support. Our first mechanical signal from IBD, uptrend under pressure. And you see the scores on the accumulation distribution. I will make a note, not been able to update this in the last couple days. IBD has made some changes to their subscription model, and they are having a massive amount of problems with their website, so not been able to access that. But anyhow, I presume, based on the price action, that we're probably still an uptrend under pressure. In terms of GMI index, this one is accurate, and this is a 2 out of 6 with a sell signal since 5-4. The more sensitive GMI2 is still at a 1 out of 8. Decision points, no change here from what was reported yesterday. And you see on the short term, it looks very, very ugly, though the intermediate term is still holding up and the long term is quite mixed. Consensus of all this is that you have a market in transition with a bias to the downside. Position sizing opinions remain the same at 50% for portfolio, 75% for active trader based on volatility. Intermediate term market posture, this continues to deteriorate, and we see now the S&P and the Dow have gone into the strongly bearish category. NASDAQ severely bearish category, and the Russell has been in relative terms the strongest, but is also solidly bearish at this point. This is in terms of hedge warning status, a level 1 plus, caution with an increasing number of warnings firing. And in terms of our strategy opinions, no change from really any of this week. The VIX is acceptable to initiate new positions for novice traders in terms of option income strategies. However, against the cloud of multiple other warnings, we suggest significant defensiveness in the initiation of new positions. Covered calls and put selling not acceptable to initiate new positions, with those intermediate term market postures being as bearish as they are. In terms of specific warnings, we've had that ratio warning is once again has fired. Distribution day count remains very high. VIX phase has been slowly increasing, but nothing, terribly exciting. Current 10-day expected move running right at our warning area, right about a 40. And then we also still have all 5 of the key intermarket risk aversion indicators as risk off, and none of them are showing any signs of rolling up yet. In terms of sentiment, medium-term stocks, somewhat elevated sentiment. Bonds certainly are at elevated sentiment, so continue to watch for signs of reversal patterns on those too. And our composite sentiment indicator, the fear and greed index that we pick up off CNN Money, you see this continues to just ever so slowly kind of oscillate into this area near neutral. In terms of sectors, percent change and our sector specific, look at the short to intermediate term. Really only 2 continue to hold up: consumer staples and utilities. Very, very defensive plays. They're the ones that are holding up best in the face of this continued weakness, and we've not seen any improvement in any of these sectors yet. Again, no signs of a bottom coming in as of yet. In terms of percent change, you see yesterday we had energy, healthcare were the only ones that put in anything of significance to the upside. Okay, I think that's probably enough for today. Let's go ahead and start wrap up. And I'd send out a couple emails this week. One thing that we do is we send out an alert when hedge risk level changes, and very every now and then we'll send out a blog article or something like that. Something catches my interest and gets me spurred to write about it. You can get those emails very simply. You just go to this website right here, scroll down just a little bit, you'll see this button, click that button, it'll ask you for your first and last name and then of course your email address, and that will get you signed up to be on that distribution. We don't sell those lists to anybody, and we certainly don't bombard you with a lot of unnecessary noise at all. So go ahead and sign up for that email. Very simple to do that. You could also go through your smartphone and just text Falcon Global, all one word, to this number 22828, and that will get you started as well. That will also get you the hyperlink to get and download the ebook about portfolio strategy. So both of those will take care of you there. So keep that in mind. And then I'll just scroll through the rest of these today. I usually just comment about one special offer. Just hit pause if you need to slow down and review something there in more effort. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you'll note the hyperlink down here to take you to the full set of disclosures. We'll see you back here on Monday morning with the Falcon Global Market Preview. In the meantime, good trading.